To say the U.S. economy has been difficult to read is an understatement. From generationally high inflation and interest rates to concerns about the labor market, it's no wonder consumers are unsure about the overall health of the economy. In fact, in June, 59% of Americans believed the U.S. was currently in a recession, but it wasn't. Prominent economists have downgraded the probability of a recession over the next 12 months to around 15%. But the Federal Reserve's very own recession forecasting model still says there is a 60% chance of recession over the next 12 months. But after what looks like a temporary growth scare over the summer, economic growth data has been coming in generally better than expected lately, which has helped push Treasury yields higher, while at the same time pricing out the need for an aggressive rate-cutting campaign by the Fed. So, the question for fixed income markets in 2025 is how low will the Fed, absent an economic contraction, take the Fed funds rate? Current market pricing suggests the Fed will take the Fed funds rate back to around 3.5 to 3.75% in 2025. If markets are right, and the U.S. Treasury yield curve eventually reflects its historical upward sloping shape, that likely means the 10-year yield should remain around current levels. That said, the risk for the bond market is a Fed that cuts too aggressively into a still growing economy, which would then potentially rekindle inflation concerns. Moreover, as it relates to the Trump presidency, there is a concern that deficit spending, which would have likely happened under a Harris presidency as well, and tariffs could help growth, but also keep inflationary pressures elevated. Better economic growth data and perhaps a too dovish Fed, along with more policy details from the Trump administration, could push Treasury yields higher. It will likely take negative economic surprises for yields to fall meaningfully from current levels, so investors should continue to prioritize income opportunities, which remain plentiful. Despite the ongoing supply discussion, we think the 10-year Treasury yield could end the year between 3.75 to 4.25% and into 2025 with risks to both the upside and downside roughly balanced. In this new, higher for longer interest rate environment, income-oriented investors have a plethora of opportunities to build portfolios that can generate income levels in excess of 5%. Much better than the opportunities that were available during the last decade when interest rates were near zero. Now, with interest rates still elevated, one might even call this current environment a golden age for income investors.